Okay, hi everybody. My name's Joey. I'm the VP of Marketing here at Cubex, and I'm joined today by two esteemed key opinion leaders in the animal health industry. I've got Pam and Cami, and I'll hand it off to you guys to introduce yourselves because you're going to do it much better than I can.
Pam, why don't you go first?
Okay, great. My name is Pam Stevenson. Professionally, I go by Pamela, if you want to Google me. And I am a CVPM. I've been a CVPM since 1992, and I have many decades of experience both in patient care and management, and being an instructor for both Patterson Veterinary University and the University of Florida, and a speaker for Cubex, other manufacturers, and at conferences both local and national. So I've been in this career a very long time and absolutely love it. And I love being involved with things like this Cubex study.
Great.
Well, I'm Cami Bailey, known as Camilla C. Bailey, the CPA for vets. And I have been a CPA for over 30 years and working with veterinarians for over 20 years. I have been a speaker at many conferences. I've helped with publishing and studies, and helped clients work through transitions, help them become profitable, done a lot of different things. And I am excited to be involved with this Cubex study because it's been very interesting to see the results of it. And I'm happy to be here today. Great.
Thank you, Cami and Pamela. And just for those of you who are watching who aren't familiar with this study, you can. I'm going to put a link right here. You can click on it and actually get the PDF of this case study. We looked at 4 practices who implemented Cubex very late in 2019 or very early in 2020, and we looked at it was like a 6 to 10 month period of time, depending on the practice, in 2020, and then we looked at that same exact period of time for each practice in 2019. And we compared the amount of revenue that was brought in for the SKUs, the drugs that Cubex managed in that year-over-year time frame, so 2020 versus 2019. And then we looked at the entire practice. We looked at patient visits during that period in 2020 versus 2019, and also we looked at the overall growth of all the revenue in the practice. Of those practices from 2020 to 2019. Actually, I think the way we define it for the case study, we looked at the revenue from Cubex SKUs, and then we looked at all other revenue. And these Cubex units were managing largely controlled substances. So the amount of practice revenue that they were managing was, a minority of revenue, but the results were very interesting in that the growth in the SKUs, the revenue, I'm going to start that again. But the results from the case study were really interesting because the growth in revenue from the SKUs that Cubex managed far outpaced growth in all other revenue at the practice. And that's what we're going to talk about a little later on here. But first, Pam, I thought maybe you could start us off with just some contextual discussion around the veterinary practice pharmacy. And how pharmacy sales for small animal veterinarians have changed over the last decade, what environmental factors and the macro environment are impacting that segment of the business.
Absolutely. Over the last 10 years or so, the net margin on the hospital in general has declined about 7%. And, that comes right off the bottom line, which of course comes right from the owners. And some of that is from differences in pharmacy. Our ability to have the margins that we used to have on products is definitely lessened because of competition. But we also have quite a few more drugs that are a lot more expensive, even vaccines and drugs that are a lot more expensive than they used to be. And you can't put a standard, quote, standard markup on those because they'd become cost prohibitive. So those things alone have a lot to do with the pharmacy. And one of the concerns that people have is that they're going to, quote, lose their pharmacy. And they're not. There's a large percentage of people that still want to get their medications from their veterinarian. And we have numerous injectable medications and other medications that can only be given in the clinic that can make a big difference. So we're far from losing our pharmacy inventory, but it sure feels like that when you get so many requests for out of the hospital pharmacy refills and prescriptions. So it has changed dramatically in the last 10 years. But just like everything else, veterinarians are the best at adapting, and we will adapt to this too. And part of how we can adapt to this is to make sure we capture the profitability and the revenue from what we're doing. And that's where these cabinets come in.
Great. Oh, thank you, Pam. So just to focus in on that a little bit more, as you know, I was an IDEXer for the first 14 years of my career in animal health. And IDEX, like a lot of large manufacturers, was very good about every year on January 1st passing along that price increase of 4 to 6, sometimes more, 4 to 6% onto the veterinary customer. And what it sounds like I heard you say is that for some core medications like vaccines, practices are reluctant to issue a commensurate price increase every year of 4 or 5%, because in a few years it would become cost prohibitive for the pet owner. Is that correct?
That's absolutely true, and that applies to a number of medications and a number of vaccines and injectables and tablets, and that's why making sure that we capture the revenue that we are earning from them, that we capture all of it when it's used.
Great. Thanks. So, Cammie, just to switch over to you, with all of your experience as a CPA for vets, which, by the way, is a great name as a marketer, I love that because it says what it is. I'm sure that you're hearing more about Ebitda today from your clients, right, than 10, 15 years ago, because practices are now increasingly Ebitda focused. What do you see in your practice in terms of let's call it a spectrum of profitability? I imagine you got some practices that have a negative Ebitda and some that are quite profitable. What are some of the trends that you see in those practices?
Well, what I've seen over the years is what us in the Valuation Council of Vet Partners has called the NOLO practice. There are NOLO practices which are basically where the owner owns a job and it really is not saleable. So the EBITDA on that, as you say, is either very low or could even be negative. And then there are those that are profitable, and profitable in the eyes of the Valuation Council is anywhere from 16% on up. You have a healthy practice if you have profitability of 16%, and you're in a really good shape if you can get yourself up to 20 or above. So that's what I work with my clients on, is their profitability and getting the EBITDA and up as well as their profitability, because that's what's important, especially in the transition world, which we're all living in right now, a lot.
Right. And, for those who don't have the kind of financial experience you do, I think it's easy to associate some aspects of a practice with profitability that aren't necessarily associated with that financial aspect of a practice. For instance, it's easy to assume that having more veterinarians on staff automatically makes the practice more profitable, will automatically increase the Ebitda, or building a nice shiny new building will automatically lead to profitability. What are some of the things that you've seen that are usually good investments and maybe others that are maybe pitfalls?
Well, when I work with my clients, normally the place that I focus on is cost of sales and making sure that they are generating the revenue and managing their costs the way that they should. And looking at their pharmacy and looking at their labs and making sure that the percentages and the benchmarks are where they are is how they become profitable. And just like you say, not necessarily adding another exam room or adding another a doctor is going to make a difference. Managing expenses will drop right down to the bottom line.
Yeah, exactly. And And that is sometimes that's the important but not urgent work that we see sometimes. It's exciting to hire a new doctor or to buy that ultrasound or what have you. But
We'll find that new doctor first.
well, that's the other side of this, right? Which is
Yeah.
the labor shortage
Yeah.
that's out there. And we actually we presented alongside ABMA, the ABMA economics team, a few weeks ago for some of our customers, and it's incredible how low the unemployment rate has remained for vet med, even in the midst of the pandemic, right? And really that does kind of segue us into talking about automation within the pharmacy, because oftentimes at Cubex we describe our system as an automated inventory management assistant, almost as a supplement for the staff that you have, which is in such short supply today, and one that can take over some of those low quality tasks so that the staff can focus on the higher quality, higher margin tasks like engaging with pet owners and with patients. So Pam, with you were a practice manager for what, 18, 20 years, right? In your experience, how does automating controlled substances lead to the kind of revenue growth we saw in controlled substances in this study? I mean, controlled substances aren't, financially really exciting, typically on a balance sheet. They're not sort of thought of as a profit center, but here in this study, we saw the revenue really eclipse all the other revenue in the practice just by automating them. What do you think is behind that?
Well, one of the things I think is really interesting is that you would expect that the pandemic would have had a different effect on practices. And yes, we know that most veterinary practices were very busy, but one of the things that was reduced was the routine surgeries and some of the dentistries and some things that could be put off. So the fact that these practices saw an increase in volume and profit from their controlled substances speaks even more volumes of the fact that preventing missed charges has a tremendous effect on that. And the ways that you can miss charges are only up to your imagination. There are dozens and dozens of ways, even though we feel like we don't miss charges, that we're really careful. Well, it can be something as simple as invoicing a quantity of 1 when you gave 5 mLs instead of 1 ml, because the default is 1. We can do the same thing in pills. We can do the same thing in cans of food. So that's certainly one of them. But specifically when it comes to controlled substances, since they're often invoiced by the ml or the 1/10 of an ml, it's very easy to miss charges that way. And when it's extremely busy and extremely chaotic, which most practices have been and continue to be, it's very easy in the heat of the moment to pull up a drug needed for a patient and then forget to go back and put it in the record. It's written in the medical record, but it might, if it's not invoiced, it's not going to be in that part of the record, not on the invoice. And that's some of the ways that you can miss charges. And there's some great tools that you have available to you to capture those charges and keep your medical records accurate and your DEA logs, which is a whole nother topic.
Right. And this study didn't even really get into log accuracy, right?
Yeah.
So that's an entire other topic. So, Cami, if we kind of pivot from Ebitda, which is today, to like practice value, which is the future. It's in everyone's future, whether you sell from one independent to another, or you sell to a consolidator. What impacts practice value, and more specifically, you mentioned earlier how important it is to lower expenses. How does lowering expenses, lowering cost of goods by virtue of increasing Ebitda, or increasing revenue rather, how does that impact practice value?
Well, obviously, the more profit you can get to the bottom line and the higher your EBITDA, the higher your value, because the value that somebody is going to pay you is based on EBITDA. And when your profitability is like in the 16 to 20% range, they'll pay a much higher EBITDA value. They'll pay like 8 to 10 times EBITDA. And if it's in a lower range, like in, maybe 4 times, if it's a lower profitability, like 5% or 7%, you might only get 3 times EBITDA or 5 times EBITDA. So, I mean, it is very impactful the higher your profitability is, and the more likely you are to sell for a much, much, much greater value. Recently, I've had some clients that have sold for 8, 9, and 10 times EBITDA because they're very, very profitable.
Okay, so it's non-linear. So in other words, just going from 5 to 10% EBITDA doesn't double the sales price. It can multiply it by 4 or 5 times, because to your point, if I multiply 10% of a million, let's say $100,000 times 8 or 10, that's 800,000 to a million. If I multiply 5% of a million, 50,000 by 3 or 4, as you mentioned, then that's 150 to 200,000. So instead of getting 800,000 to a million for that practice, I only would get a couple $100,000. So
right.
It's a huge difference.
Yes.
In enterprise value, non-linear, which is not, humans aren't good at thinking that way.
Right.
Like
it definitely is nonlinear, especially in the consolidation world, because sometimes there's offers that are kind of unbelievable, and then other times, they're what you would expect. So it's a crazy world out there right now, but profitability is the name of the game, and having a good EBITDA is very, very important. It's kind of funny you bring up EBITDA, because just in the last, I don't know, week, I've had probably 3 clients ask me, what is EBITDA and what is my EBITDA?
Maybe that will be our next video.
There you go. By the way, it is earnings before income taxes, depreciation, and amortization, and interest. I'll get it all in there, whether it's in the right order or not, just so people know.
Yeah.
Of course, then the follow-up question is, what on earth is amortization? I had to Google that earlier today for a conversation. I'm just like, so.
Yeah.
And the sweet spot is increasing the revenue too, because like Cammie mentioned, reducing the expenses is what we need to do. And then anytime we can increase the revenue by something as simple as capturing charges for everything that we do, that has a doubling effect. And that too isn't a linear effect, in that increasing the revenue is going to decrease the expense effect. And if you combine that with revenue, reducing your expenses as much as possible, it is definitely the sweet spot. And it provides a practice income that the practice owners can use to fund their retirement, so that when it does come time for a sale, they're not as quite invested in how much the sale is. Yes, it's always important, but if you have enough money to fund your retirement from your long-term career, then you can have more choices in your sale.
That's a really interesting point, Pam, because you and I have both probably known practice owners who they put everything on black at the casino, right? Like they're betting their whole retirement on the sale of the practice, yeah. Right? Which once somebody's a couple of years away from retirement, it's hard to unwind that. But for veterinarians who are earlier in their career, maybe who just took over ownership of a practice, can both of you guys talk a little bit about sort of healthy habits in terms of mindset for retirement, and how the practice value, whatever the equity that you get a return on, how that figures into your whole retirement picture?
Mm-hmm.
We're a little bit off track here, but it's interesting.
Well, I certainly can. I think that it's very important. A lot of the veterinarians that I work with aren't focused on the money because they've been trained for medical services, and that's understandable. But as an entrepreneur, you need to focus on finances and running a profitable business. If you run a profitable business, it will allow you to put away for your retirement and then also be able to have a practice at the end that you can sell and ensure that you have a comfortable retirement. I think that's very important. You've got to take off those blinders and look at your business. It's really, really important.
Great.
And there's this mental block against the word profit. And we need to get past that. One of the reasons is that our revenues and our profits are right along with other industries. And it's no more, no less than healthcare. It's often a little bit less than healthcare, but not. There's this feeling that we have to be real careful about making too much money. There's no such thing as a veterinarian that makes too much money. So like Cammie said, get past the fear or the anxiety that the word profit produces. Because if you start saving and funding yourself, and number one, pay yourself first. We have to make sure that the practice owner is paid, but start investing in your retirement early. And the dollar cost averaging, which I'm sure Cammie can explain a whole lot better than I can, but saving smaller amounts early over a long period of time is going to earn you just as much money as a large sale without the tax consequences or without the extreme tax consequences. So
Right.
It is important that profitability is considered and that people are educated and your team is educated about the need for profit and what happens to the profit in the practice. Nobody's lining their pockets with it, I promise you.
Right, right.
Right. Well, thank you guys so much for joining me today to discuss this case study. Again, there's a link that just popped up for that the full case study. You can read it, and hopefully we'll have another chat again soon. This was terrific.
Thank you.
Thank you. It was fun.